Hey there, and welcome to another episode of the Pure Property Podcast. Today's episode, we're going to be running through the common mistakes that people make when investing in property. So these are the top mistakes. Property is very easy to make a lot of mistakes. So obviously we're not going to cover them all, but these are the top ones that we would consider as mistakes, and how you can potentially avoid them. But these are the top common mistakes. So kicking things off, common mistake number one, lack of research and due diligence.
Very common, probably one of the most common ones we know for sure.
Yep.
What would you say is something that people can do to maybe find, I guess, viable or good sources to look into data-wise for maybe what a good area would be?
Yeah, I think, look, due diligence and research is very, very important.
Massive.
Okay, so first things first, yes, you have to do that. That's quite an easy mistake that people will make by not carrying out the right research, being lazy, not carrying out the due diligence.
Although you can speak to a professional, but you need to make sure they're
you
a professional.
can, yeah, but again, how do you vet
though,
that? So to get a basic knowledge, go on Google, have a look about property articles, stuff like that. Go on Rightmove, research the area, what the price is doing, what the rent's doing, how many available, how many have sold, how many available to let, how many have been let out. You can see all that information quite easily on Rightmove. And then what I would probably do is research particular areas. You can go on YouTube, research a lot of information out there. As I mentioned, Google, there's a lot you can find on there. Property related podcasts. Yeah. So there's a lot of research you can do just in general about property investing, but about a certain location. Look, there's lots of data out there. Savills, Knight Frank, JLL all produce reports. Home Track produce reports for certain cities. There's loads of information just by typing into Google. You can get news alerts on Google, which will alert you every time a property-related article comes out.
Yeah, good points. And then to head over to more due diligence, I'd say fact check sometimes numbers, rents-wise on certain things, or what maybe you're being told by, we could say, a professional or whoever's going to be maybe even managing your property. And we've seen it a couple of times now where, unfortunately, a letting agent will maybe price up a certain apartment and say, look, this is what you're going to be getting. You've maybe then got a mortgage already and you've got roughly how much profit and then all of a sudden it doesn't rent out at that price, and they're now encouraging you to drop down the price. And maybe where they can maybe see as well market comparables, what's out there. I think a number of things you could put into due diligence and fact checking things in general.
Yeah, look, utilising the internet's massive for that. Speaking to local agents, speaking to local letting agents, speaking to people on the ground locally where you're looking to invest is a big thing. But that is a big common mistake, lack of research and due diligence, because people think it's easy to invest in property. It is not easy. There's lots of mistakes that you can make. There's lots of risk involved. So make sure you do your due diligence and research massively. It's a big thing, and I can't say that enough. Even clients we deal with, I recommend them. Yes, they're sort of utilising us and our experience, our expertise, but I always say still go do your own due diligence.
We do get a small handful that have had a mistake or had issues, and then they've come to us after, and it's a lot of the time it's just wasting their time and their money as well, which is unfortunate. But at least I guess sometimes it is the common theme of, like, it needs to happen once to then realise that next time you want to do things a different way, or actually do a bit more due diligence than going out on a whim. Yeah,
so the next one, emotional investing. So, like fear, greed, these sort of things can influence decisions. But yeah, that is a common mistake.
Massive.
What would you give an example of emotional investing?
Seeing a property that you fall in love with and it's an investment property.
I would love to live here.
You end up paying over the asking price. Even at auction, you could be in a bidding war and end up paying way over
emotional
price.
Investing. Exactly.
Which, a lot of the time we do see people really engaging. I mean, we have it in properties that we deal with as well. Apartments, city centre apartments, and they absolutely fixated on certain views and certain rooms, which can be obviously a good factor. But realistically, from a rental standpoint, you're not living there. You're there realistically to get the best return and maximise your funds, essentially.
But it's all about the numbers at the end of the day. There should be no emotion involved. if you're into a bidding war with someone, forget what the other person's bidding. Don't get emotionally invested that you want to win that bid. Set your price. You know you won't go over that. Bang, that's sorted.
Comes back to also doing your due diligence and fact checking as well.
Yep. Never think of a property, I want to buy something that I would live in. Wherever you want to live in is very different to what a lot of other people want to live in, or maybe that area is very different to what that area needs for properties as well to rent out. So
it's the misconception about you thinking that I wouldn't want to live here.
Yeah.
So no one else would want to live there. It's not the case at all.
Far from that. Yeah, emotional investing is a very big thing, and you do need to stay disciplined. Stick to your plan, stick to your numbers, stick to your strategy.
Think of it as a business, right?
Exactly, that's what I always say. Think of property investing as a business. Take the emotional side out. Just think of it as business. And then common mistake number 3, over diversification or under diversification. Now, we actually did a whole episode on diversification, didn't we? But yeah, that is definitely a mistake we probably make. Well, not we make, but we see people make.
Yeah, I'm a fan of diversification.
I agree.
I mean, I do still see the benefits of some people obviously having a lot of their, I guess, properties in one area.
Yep.
And maybe a certain type of property, a standard maybe buy-to-let, etc.
Yep.
Or, as we said, people have HMOs, you've got buy-to-lets, you've got multiple different options nowadays which you can go down the route of. But yeah, I would say, as we know, as we've seen in London, maybe if you were to buy or heavily have invested into London, you might have seen quite a stagnated bit of growth over the past few years where that money could have been maybe maximised and really benefited from growth maybe in the likes of the Midlands and the north of the UK. So
yeah,
I feel as though, it's something that we see all the time, isn't it? About, should I invest maybe in another one here or look elsewhere?
So what about over diversification? Because we do promote diversification, but can you over diversify?
You probably can.
Yeah, overdo it. Spinning too many plates, too many locations.
Yeah, I think you can try and sometimes as well do too much at once and it gets a little bit out of hand. And as I said, realistically, if that is the case, you're probably going to be dealing with multiple, if you're hands off anyway, you're dealing with probably multiple rental management companies that you're dealing with that are dealing with all different types of properties. And I guess I do get the reason why sometimes people will stick to a certain area. They know exactly the same letting agent who they use, and it's very comfortable, right?
Yep.
But yeah, I do think there could be an element of that. I think it's down to the investor though as well. What time they've got on their hands as well.
Exactly that. I think diversification is key. It's good to have a balance. You can move with markets, but you don't want to, like you said, you don't want to go too overboard. Buy a property in every single town or city in the UK. I think having a nice balance there of a diversified portfolio which can work well in different markets. So this side of your portfolio,
don't you think it's hard to understand, especially if you're diversifying?
Yeah,
it's hard to be an expert in every single area.
Yeah,
it's just
agreed. So yeah, I mean, look, best thing to do is just seek good advice. Diversify where you feel comfortable, when you feel comfortable, and then, but yeah, definitely don't just focus on one place. You want to be making sure that you do spread out a bit more. It's risky to not diversify, but on the other hand, it is risky still to over diversify. So just find somewhere in the middle. Easier said than done, but if you do need help with that, just let us know, and we'll be happy to talk you through how we can help you do that. Chasing performance is another common mistake. So chasing performance of previous transactions potentially. So I do see this quite a lot, and I actually nearly fell into this trap. So my version of chasing performance was when I bought many years ago in a location I invested in. Prices were great. Got in a great time. Over the years after that, prices jumped up. I went to go buy another property and I thought, no, I can't buy that. It's my other one's performing so well, and I performed well and got myself a bargain. Now look at the prices, I'd rather not. I changed my mindset straight away and did buy. But you need to think of it like, that's past performance. What can you do today? What can you do today in today's market? A couple of years ago, it might have been better. It might have been cheaper. Maybe the yields are slightly higher. But if that's gone, don't dwell on that. Just focus on what you can do now, not your past performance. And that goes for a bad past performance as well. You might have a performance where you invested in property and it went horribly wrong. And that might put you off investing.
I think
in
it also
property.
comes down to the fundamentals and the affordability levels of the area after it's had the growth or benefited massively. And we saw it with him, I think, a couple of investors for the likes of maybe Liverpool, where they were looking at one beds at 130, 150, and now they've bought in maybe at that price. And now they're seeing that a one bed's a 180, 190, and they're like, I don't want to buy that. But yet, the investment fundamentals are still there to still see that growth. Where if when it gets to maybe the likes of 200 and further, then they might be regretting that at a later stage because they didn't get in. But yeah, I think it's definitely something we see. And I think there's pros and cons to both.
Yeah, for sure. It's about finding that balance, isn't it? Yeah. And the last common mistake is market timing. So this mistake.
Go on, Toby loves gone. I know he wants to add his little quote in there that he loves using.
It's not time in the market. It's time in the market.
There you are.
So the first one, it's not time in the market. It's not like, waiting for the crash. I'm going to time the crash. I'm going to buy at the lowest point. Because that's
exactly the same with mortgage rates, interest rates.
It's pretty much impossible. Unless you've got a crystal ball, it's impossible. But it's about spending time in the market. But in terms of the mistake people make, look, the biggest mistake when sort of market timing wise is trying to wait for the crash. This crash is going to come. I know it's going to come. People have been saying that for the last 6-7 years. Still hasn't come yet.
Now we've got the forecast for growth.
Oh, exactly, which all looks positive and how stuff's going. So, you can miss opportunities by trying to time the market. You can be too late to the party. You can get a little bit too early. So, time in the market is something that people want to do, love the idea of doing, but actually doing it is quite hard. Now, the main thing you want to do is focus on spending time in the market, buying, hold medium to long term and seeing the benefits of that. That's the main thing. You want your nice, consistent flowing benefits from remaining in the market long term, not trying to time the market. Would you agree?
Exactly that. So everything you mentioned is exactly what I would have said and reiterated.
That's the most common 5 mistakes that we know of. Easily done, especially for new investors. But I think it's about taking them on board, considering them and definitely thinking about them when you are looking to invest in property.
Yeah, I agree. I think it's a lot of points that I think people maybe even have bits of both, maybe 2 or 3 of those problems all at once, and they're thinking, what's the right thing to do here?
And it's not. You want to be cautious of the mistakes, but mistakes will happen. But again, it's all about taking advice, speaking to people that are doing it, speaking to professionals, and that should help mitigate the risk of you sort of doing that.
I personally don't know anyone who kind of has regretted buying at a certain stage. And I always get the exact same story. People going, I wish I bought sooner.
I wish I never sold that property.
Yeah, exactly. So I think overall, if you're looking for something, as you said, in the medium to long term, then property in majority of locations, of course, make sure you're doing your DD as we spoke about. Yeah. But it can be a it can be a lucrative investment over the medium to long term. Yeah, agreed. Right. So that's the 5 top most common mistakes that we see in property investing. Mistakes are easily made, so do bear that in mind. It's about reducing the number of mistakes you make. If you can get it perfect, great, but not everyone will. But definitely do consider those. And there is definitely more, but they're the main ones that we see. And sometimes the ones that can be the most detrimental to your property investment. So do consider them. And look, if you need any advice, speak to professionals, speak to people already investing in property, experienced people. Companies such as ourselves, Track Capital, we can help speak you through stuff as well. So any help you need, always ask, because when you're inexperienced, that's when these will and more likely take place. So lean on others that are more experienced and that should be able to assist you. Even if it's just a conversation at first, right? Yeah, exactly. Just a convo, get a bit. You can then make your own informed decision off the back of that. Yeah, exactly that. Right. Boom. Thanks for joining us on that one. It was a nice sort of quick one that time. But feel free to reach out just with any comments, or if you want any sort of any topics covered on an episode, reach out, info@trackcapital.co.uk, and we'll be happy to include them. Any questions, anything you want to discuss, reach out. We'd love to hear it. We'll see you next time. Bye.